We have with us Thomas Eichenberger, who is a member of the executive board at Sygnum, which is one of only two purely crypto banks in Switzerland, and he will talk about success factors in the implementation. So, Thomas, the stage is yours.
Thank you, Sonny. Thank you so much. So, before I'll talk about success factors when it comes to the implementation of blockchain solutions for banks, let me start with talking about the challenges that banks may face on their way and the decisions that decision takers at banks need to take when it comes to the implementation of blockchain solutions for banks, and more explicitly, dealing in digital assets. But I think before I talk about the challenges that banks may face when it comes to the implementation of blockchain solutions and digital assets, I think we all need to acknowledge the fact that one of the biggest challenges that banks nowadays still face when it comes to blockchain solutions and digital assets, these banks have already overcome when they think about how to best implement blockchain solutions. Because the key challenge that usually banks are facing these days is the question as to whether they acknowledge the potential that digital assets may have and the potential disruption that they may bring to our industry in general. So when they think about the implementation, they have already taken a very important hurdle or challenge, and that's, I think, the very important first step in order to then move forward and execute on that strategy that they may have derived based on all the inputs that we have heard on the previous panel. Now, when it comes to then really the implementation of blockchain solutions for banks, and unfortunately my slides are not turning, now they do. I think at the very beginning of that journey, there is a very fundamental question that banks always face whenever they think about implementing new solutions. It's a very traditional buy versus build decision that they need to take. I'm not going to talk about the buy versus build, and I think there's a third and very beautiful hybrid option, which is the partner option that you could also consider. I'm not going to talk about this challenge or this decision in particular, but I want to basically use that and apply that to two particular dimensions that banks need to address and where they need to make their decisions as to whether they go with a buy, a build, or a partner approach. The first dimension is a pretty obvious one. The first dimension is how they treat infrastructure. As we all know, and there are quite a number of participants and also speakers among today's participants that do deal in operating or developing and operating and building digital asset infrastructure, in particular custody solutions. I see Adrian in one of the front rows, and I think he'll be speaking later. We have Andy later who will talk about trading solutions for digital assets. So there's a huge question mark around how do we develop, build, operate, and maintain infrastructure when it comes to dealing in digital assets. And in particular, I think there are 4 requirements towards this infrastructure that are extremely relevant for banks and that banks need to address when they make their assessment as to whether they feel they are capable of dealing with these challenges themselves or whether they want to partner with someone on that journey, at least to start with, and that may bring them to a certain point at which they feel comfortable to operate such infrastructure themselves. One of the key requirements, and probably the key requirement, and we heard it before, I think, from Jonathan, is security. As a bank, or as banks, we are in the business of selling trust and selling peace of mind. And security becomes even more important when we deal in digital assets because the blockchain doesn't know such a thing as a reversal. So whenever you instruct a transaction or a transfer, in particular withdrawal, this transaction is processed and executed and irreversible. So there's no way to perform a reversal and bring these assets back into the infrastructure. This is especially then a problem if such a withdrawal has been executed or instructed in a fraudulent or malicious way. So dealing in security is of utmost importance, and security is, in terms of dealing in blockchain solutions, a very multi-layered challenge. It starts with developing and operating secure hardware. It's security at the transaction level, it's security at the governance level, it's controlling physical access to data centers where secure hardware is being operated, and so on and so forth. So it's really a multi-layered challenge that banks need to address and resolve when it comes to operating secure infrastructure. The next challenge or the next requirement towards the infrastructure is scalability. It's extremely important that, especially for those banks who have been many, many years longer in the business than we at Sygnum have, it's very important that they are able to manage thousands, 10,000s, if not 100,000s of wallets and addresses and process thousands, 10,000s, or 100,000s of transactions with their infrastructure. While digital assets may only be 1% of the total assets that a bank is currently managing, or 2 or 3, they may well become 5, 10, 15%, 50% of the assets that they're managing on their platform down the road. So being able to operate scalable infrastructure, and not only scalable infrastructure, but also scalable processes associated to it, is of utmost importance when it comes to implementing such infrastructure. The third element is reliability. Digital assets are by nature an asset class that is operating or trading in a 24/7 market. So we cannot afford such things as regular, longer downtimes, maintenance windows, unavailability, longer windows of end-of-day processing and the likes. Our clients want and have the right to, I believe, to trade on a 24/7 basis. Hence, the systems must support that. And finally, there's a requirement towards integration. While blockchain solutions or blockchain-related infrastructure may per se be a standalone solutions in the first place, developed and operated and maintained by specialized providers, there needs to be a certain level of integration into existing infrastructure and architecture such that your clients will be able to trade, as I said, on a scalable basis and on a reliable basis, and you will be able to operate such infrastructure also when your business grows quite significantly over time. Now, the second dimension may not be that obvious, but is equally important, which is compliance. And I think we also heard some statements about it before. I think one of the key aspects when it comes to compliance when dealing in digital assets is having a proper anti-money laundering and counter-terrorist financing framework in place. And with that, I not only mean that you are, or your compliance department, or actually the entire organization, is able to understand specific laws and regulations that are only applicable to digital assets, but that you're also able to not only understand the technical aspects, for instance, of a decentralized lending pool and admiring the beauty as to why it is so efficient to execute transactions and lend and borrow money through a decentralized lending pool, but you also understand the other aspect of it, how you can make use of this in a fully regulated environment, and that you also have people in your organization that understand technology, but understand regulatory aspects and legal aspects as well, such that you can have a meaningful dialogue with FINMA as a regulator and also take their perspective to make an argument such that you can ideally lead them to the positive outcome that you will be able, or you will be allowed to make use of decentralized lending pools as part of your offering as a bank. There are certain questions such as, if you deposit your client's USDC stablecoin into a decentralized lending pool such as Aave, there are questions like, okay, who is then the counterparty? Who is the client's counterparty, the bank's counterparty? How do we deal with that? These are problems or challenges that have not existed before blockchain solutions or DLT came into place. And there, again, being able to take both perspectives, the technology perspective, but also the compliance perspective, is extremely important, especially when it comes to discussions with the regulator, I can assure you. Then, obviously, a framework immediately translates into policies and directives. I think that's quite a natural next step, not a big one once you have defined the framework, but a more important one is the third one, which is tools. Traditional transaction monitoring tools and the traditional KYC AML tools will no longer be sufficient to ensure that all the transactions, especially those in digital assets, are happening in a fully AML compliant manner. So you will be required to select and implement tools such as blockchain forensics tools or chain analysis tools that allow you to assess AML compliance for any on-chain transaction that tries to enter into your regulated environment. And finally, it all boils down to know-how, right? Know-how, how to derive such an AML or a counter-terrorist financing framework, know how to write these policies, know how to select, implement, but also operate the tools in order to onboard assets that originate from dealing in cryptocurrencies or to clear transactions in Bitcoin that have maybe a suspicious background. And eventually, I think in both these dimensions, banks need to take the decision as to whether they want to go for a buy approach, a build approach, or a partner approach. And I can assure you that for both of these dimensions, and even the combinations of these dimensions, there are already players in the market who can help banks to overcome these hurdles. Which leads me to the success factors. I think the first one is really thoroughly assess that buy versus build decision in both dimensions. It's not a one-dimensional problem. It's really a multi-dimensional problem. And the two dimensions that I've outlined a bit in more detail today are just two of many. To me, or in my view, and also based on the discussions that we have with other banks, when it comes to them onboarding to our platform to enable their end clients to deal in digital assets through our platform, security or infrastructure, security and compliance are usually of the utmost concern. Then, it is really important that you as a bank or as an institution, you draw your long-term vision. You need to know what you want to do at some point, in 3 years, 5 years down the road. And you need to have a business case. At the same time, I would really advise not to overanalyze theoretically, right? I mean, you can write research papers, business cases, 100, 200, 300-page long essays as to how you want to go about it and why there is a potential and why there is not the potential and how big the potential is in cryptocurrencies, but also in tokenized assets. And that may change every year, if not every half a year or every quarter. So I would say, have a long-term vision, know what you want to do, but don't overanalyze theoretically and produce piles of paper without really going into implementation. Then, as a next step, I would usually advise to seize the benefits of buy, to gain first-hand experience internally, so bringing your internal organization up to speed with regards to the elements that I showed before, but also others. But even more importantly, gain first experience with your clients. Understand, is there really demand for this? How can we bring this to life? What are challenges or hurdles that we are facing then when it really comes to the nitty-gritty implementation of allowing or enabling our clients to deal in digital assets? And that may be very simple problems such as, I don't know, a settlement process that may be unfamiliar to your internal employees, and so on and so forth. So really gain that first-hand experience, I think, is an extremely important element. Because again, analysis on paper is great and is required. Otherwise, you're just going to boil the ocean and try to do A, B, C, D, E without ending up anywhere. But at the same time, at some point, you need to make a cut and say, okay, we know what we want. We have analyzed a few providers that we feel comfortable with. They are knowledgeable about their space. So let's go. Let's make a POC with them. Let's start with a pilot case with a handful of clients to gain really that first-hand experience and see whether we can deal with the complexity internally, but also whether we can unfold the potential with our clients. The fourth success factor is then also review your buy strategy based on your business case materialization and maturity of the organization. Having taken a buy or a partner approach in the first place doesn't mean that you have to stick to it forever, right? The space evolves. The materiality of the business may grow. It may grow from being 1% of your assets under management to 10, 15, 20% of assets under management, which may bring a completely different business case to the table. And suddenly, it may make sense to build that infrastructure yourselves or to operate that infrastructure yourselves and build up the knowledge in-house to do all of this yourselves with your in-house organization. And since you have already been in the game, you have had skin in the game, and you have been making your first experiences with clients, will help you to periodically make that assessment as to whether your infrastructure, but also your organization, is mature enough to operate many of these infrastructure aspects, but also the operational aspects and compliance aspects themselves. And finally, it's also the acceptance that your buy strategy may need to be revised or not. Again, you may come to the conclusion that 3 years ago, it was the perfect thing to go with a partner or to buy a solution, but now the environment around you has changed so dramatically that you may need to revise your strategy. That's not a bad thing. It's actually a good thing because you probably have saved quite a lot of money in not going for a build strategy immediately, and that's exactly the money that you can use now to maybe switch from a buy strategy to a build strategy to fulfill your own expectations, but more importantly, to meet your clients' expectations. Thank you.